Hey, 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 welcome back, everybody. This is the Flow Show. He's Steve Straza. I'm Sean McLaughlin. We're doing the Flow Show a day after we normally do. Straza's got some, dicey weather down there in Florida. It's messed with our schedule. How you doing? Are you hunkering down over there?
Hurricane season has really kicked itself off in spectacular fashion this year. So we're just getting bombed with rain, and now they tell us a Category 4 is coming. So we'll see. I was just telling Sean off air, we don't worry too much until it's like 48 hours away. That's when you worry, right? Once it's too late to really get out. But the weather reports will change drastically, like hour to hour in these times. So we're just waiting it out. We're going to see what happens.
I lived in Florida for 5 years, and people who are longtime Floridians, they're a little cavalier about hurricane warnings. They kind of wait till the last minute, rightly so, because there's so many false alarms. I feel like there's even more false alarms today than ever.
Yep.
But I feel like where you live, it's a little bit. You got to plan a little bit more because you've only got one way out, and that's one road for 4 hours. I mean, I don't know, dude.
Did you hear what I was saying on the morning show today? Like,
No.
so I was saying that exact thing. By the time we find out the truth from the weathermen about whether it's going to be bad or not, it's too late to leave, right? Because if you're trying to leave, once the news hits that the hurricane's coming and you only have like a day, 2 days to leave, it's a parking lot on the overseas highway. Unless you got a boat, you're not getting up to the mainland. So you kind of have to either take the chance or jump it and leave early. And the tough part about that is if you do leave early and plan on a hurricane, 9 out of 10 times it's not. So
Yep. For
it's
those
tough.
who are for those who are new here, Steve Straza lives pretty close to Key West, so it's a little bit different than being on mainland Florida in a hurricane.
According to my address, I do live in Key West. However, if you were here, you would say, no, 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 you live on Stock Island. So I live one island, one key above Old Town Key West. So I'm one bridge north. And it's just, conveniently named Stock Island, not because of me, but because of livestock.
Oh, I thought it was because of you. Oh man, local celebrity Steve Straza.
Bruni came to visit me one time and he goes, wait, it's actually called Stock Island? He thought I was joking, like for years. Just called where I live Stock Island. But I can see
Uh,
why.
all right, Straza, let's give the people what they want. They're here for trade ideas. What we do here in the Flow Show is Straza and I put our heads together. Straza throws some charts up of interest. We look into the options to see if there's a play to be made. Oftentimes we come up with one, sometimes we don't. But what's on your mind this week, today, Straza? What's got you excited?
I think you already have an idea of where my head is at. Let's just walk through it. Let's do a little top-down exercise here. This is XLF. This is a daily chart of XLF. Right? If I mark this up, this was the bull market, the prior cycle bull market high, right? From late or early 2022, it peaked when the major averages did. Then we got a really nice kind of basing period here, which we love to see. Nice rounding bottom, textbook primary trend reversal. XLF started moving higher off of the fall lows from last year, just like most things did. Then what did it do? It ran right back up into this old resistance at the prior cycle highs, and it's been chopping here. Notice how momentum has not been oversold. Momentum profile still looks great, bullish regime. You could draw this as something like this, a little triangle, right? Some sort of continuation pattern. Now, when we zoom out, picture looks just as good or better. Look at this structural outlook here and this is XLF, this is large cap financials, right? This is the financial crisis, big drawdown, just got back there before COVID, 2 tests failed. This is the COVID sell-off. Then we rip through. What am I trying to say? This is a fresh breakout for financials. You got the fresh breakout in 2021, hard retest as this rounding bottom pattern was printing at the bear market lows. And now we're going, it's like first target kind of hit, right? And do we break through? And then is there another strong leg higher? Well, let me tell you, first of all, let's look at the relative trend. This is financials relative to the S&P 500. This has been a terrible place to be since the financial crisis. So this is 2008 when the market bottomed. We retested this level on relative terms last year during the regional banking crisis. No, I'm sorry. This is the pandemic lows. And then we came close to retesting it during the regional banking crisis last year. And now we're back there again this year. We're close again. So I think when you zoom in here, throw up momentum, you have this shelf of, or this low from the prior cycle, or from last year rather. And you also have a sweet momentum divergence. historically, if you just zoom out, this has been a great place to add exposure to financials on a relative basis, right? Down at the lower bounds of this range. What is driving the performance in XLF? Sure, there's some good broker dealers and capital market stocks in there, but it's the banks, Sean. It's charts like this from the big banks. This is JP Morgan. Flip it to a daily. So good. It looks like a tech stock, right? Took out the prior cycle highs shown here, like first target hit, continuation pattern. Now it looks like it's ready to go for some more. Bank of America is another one that stands out. I think this one's more of like fresh reversal pattern sort of a situation. JP Morgan would be a leader. This wouldn't be necessarily a laggard. The laggards are in the regional bank space, but it's middle of the pack. You're just kind of getting that trend reversal now. And then we got like a couple of months of sideways on top of it, which I love. So maybe this one's ready for another leg higher. What I'm trying to say to you, Sean, is that I like the big banks. Where's your head at on this industry group?
So I too like the big banks. However, as we know, the banks kick off earnings season, and that's coming. Now, that could play in our favor. That's not necessarily a bad thing, right? If we get one good report from one of these big banks, it could send them all higher, right?
Hey, you're right. Just a 2 week earnings season again.
I know, it's crazy, but the earnings season that happens in the middle of summer always catches me off guard. So I feel like everything's slowing down now. Everyone's taking time. We got vacations coming up. I certainly have some vacations coming up. Like, I'm just not thinking of that. And then boom, it's earnings. Wait, what?
I know.
Catches me by surprise every year. But the banks kick it off in, I believe, 2 weeks. Goldman Sachs, for instance, is one of the names that I've been keeping an eye on. I like it a lot. That's got earnings on July 15th. Now, look, it doesn't mean we can't play at Straza. It just means we need to be mindful of these risks and, put ourselves in a position that if we're wrong, if one of these things takes a big hit, it's not going to kill us. That's the name of the game.
I have an idea, Sean. If we went a little bit further out, extended our time frame a bit, made this like a monster-based breakout trade, maybe one earnings report has less of an impact. What if we did leaps on a chart that looks like XLF? What I'm talking about is a financial crisis-based breakout. That could insulate us a little bit from like some near-term noise or chop. I think of Morgan Stanley. When I think of like these dot-com bubble or financial crisis bases, like look at Morgan right here. This is where Morgan was this is prior to the dot-com bubble. This is a financial crisis. So this is a 25-year base. And then right at the base breakout level, I remember when NVIDIA looked like this. Right at the base breakout level, we have this nice little continuation pattern, which I think is just about going. What if we zoomed out a bit and did a real long-term setup on something like Morgan? This is the base breakout reaction leg higher that we'd be betting on. So if we did leap something summer of next year, I don't know. How would that?
Well, I like where your head's at. If we went to, let's say, December of next year, December 2025, check this out. We could buy for me, it's just a psychological level, but I like buying things under $10. I don't know why. That's maybe a terrible thing to say out loud to admit publicly, but $10 kind of tends to be the price. I'm like, okay, if it's more than $10 for a call option, I'm getting a little worried about it. But that said, full disclaimer, if you look at the December 2025, so that's a year and a half to expiration, you could buy the 105 strike calls for under $10 for
That's
nine.
ridiculous.
Yeah. And my thought, even before I even looked at these prices, Straza, it was, what if we bought like the 100 or 105 calls and maybe found something to sell against it in the meantime, just to help lower the sting a little bit? In August options, we could sell the 105 August options for $1. So that would just kind of, lower the cost a little bit from 9 and change to 8 and change. And, creating a calendar spread of sorts. And depending on how much we want to, how much effort we want to put into it, if Morgan Stanley doesn't break out, maybe we keep rolling those short calls for additional credit, as long as we're above a key level, right? Obviously we have a stop loss on the whole thing. If there's a level on the chart that we don't like and it breaks it, we're out of the whole thing. But if it just takes its time, maybe we roll those short calls a couple of times, keep bringing in extra credit just to lower our exposure, to put ourselves in a better position to win. I mean, there's a lot of different ways we could do it. A call calendar spread gives us a lot of flexibility. What do you think?
You'd be selling the 105 calls that expire when?
In August. So 45 days from now.
If by August we're still kind of chopping around, you could sell the 105 Septembers.
Exactly.
Yeah.
We don't have to. It's just an option, right? It's just a way of lowering our exposure while we wait out the move. And now, the smart people will say, okay, well, what happens if Morgan Stanley does have a great earnings reaction and it opens up at 110 the day after our earnings, and we're short the 105 calls in August? Okay, good question. Because we're considering doing a call calendar spread that involves the long options that don't expire for a year and a half, we've got a lot of time from now until then. So let's just, for argument's sake, let's say Morgan Stanley opens at 110. Those August 105 calls that we short are now in the money and they're working against us. That's a bad situation. Well, what we can maybe look to do at that point is we can buy to close those August 105 calls. And maybe we have to go out to as far as, I don't know, October or November and sell the 110 calls, which is now the at the money strike, to get it and do it for a credit. That just keeps us in the trade, improves our position, and we could keep doing that. We have 18 months to work with, right? We could find a certain options expiration, or a monthly options expiration that we could roll to for credit. We always want to do the rolls for credits, ideally, right? That's how you improve your position. And meanwhile, as we're rolling for credits, we're still long those 105 calls in December that have 18 months to expire. Those are still working for us. We're just trying to find a short strike that will eventually expire worthless. That's the goal. But at any time, of course, we could take the trade off. If we do a couple rolls like that, Straza, where we roll to 110, I mean, maybe we roll to 115 and roll to 120. Every time we do that, our trade is still working for us, and we will have an opportunity to take the whole thing off for a profit. Maybe not as much of a profit had we just been long the calls, right? But
if it's like you're losing money on the short calls, it's because you're also at the same time making money on the long calls.
Right. It's a first class problem to have, right? Not making as much money as you would like to make. And again, it's a trade-off, right? Everything we do in options trading is a trade-off. If I'm selling calls to help finance a longer dated call, that, I'm doing that to lower my risk, but the trade-off is it could potentially limit my gains if this thing really takes off on us. But as we know about banks, Straza, banks can trend very well, but rarely do they have parabolic moves, right? This thing's not going to go from 100 to $150 in 2 days. I mean, certainly it could happen, but I mean, when's the last time we saw a bank do that, especially already this far into a bull market, right? It's not like it's not like we're at the COVID low today and we're about to bounce. We've already been in an extended bull market here for a little while. I mean, yes, we've been consolidating, but I feel like maybe this is a good play, and it'll take a little monitoring, a little extra massaging, so to speak, with those short options. But I'm all about lowering my risk, and I'm all about, getting paid to wait if we have to.
So as I learn about these option strategies, let's just do this educational bit right out loud. This is Morgan Stanley. We got a 25-year base breakout in the making. However, we're trying to decide whether or not we should just go long calls, just buy some leaps, right? Or if we put on a bull or a call calendar spread. Now, if you think that up here at the upper bounds, right, we've been range bound for a while now. This is the entire cycle shown in a range here. If you think maybe we get a little bit more of this, oh, oops, wrong indicator. If you think that we get a little bit more of this, right, before we go, then you probably want the call calendar spread. If you think that maybe this range has been in place for long enough and the next leg is going to look like this, you don't want the spread. you just want to buy the leaves, right?
Right.
Those are the two options. It's, do we get a little bit more chop and a little bit more digestion or consolidation in this little range drawn in the upper right? Or is this thing ready? Are we going to go now? That's the question you have to ask yourself when you're deciding between these two strategies.
Absolutely. And we mentioned we have earnings coming up, and that is obviously that introduces some binary risk, but it also tends to elevate options premium. So if I was looking to buy, normally when I'm getting into a bullish position, I'm looking, as early as 3 months, but as long as 9 months. That's my typical window for a swing trade. If that was what I was doing here, I wouldn't want to be a straight buyer of long calls here because I'd be paying more than I would like to in premium. But the fact that we're considering options that expire 18 months from now, the effect of the implied volatility, at least in this case, doesn't feel all that onerous. It doesn't feel like we're gonna get crushed by a vol crush here. If like in the worst case scenario for someone who's long options, if Morgan Stanley announces earnings and the reaction is basically nothing, the stock opens at the same price it closed the previous day, nobody cares. Well, the options that expire, this week, next week, the following week, those premiums are going to get crushed, right? Because the volatility just went to essentially zero. It doesn't go to zero, of course, but the premiums in those options will get crushed. But the options that are much further dated, in this case, in leap territory, yeah, they're going to lose a little bit of premium, but I don't expect it's going to be that drastic.
Right.
Now, I'm sure there's some options eggheads out there who might disagree with me, and you're probably right. I'm just making a gut judgment call here based on the fact that the 105 calls in December 2025 are currently trading at $10. That to me does not feel like a very rich price for a $100 stock right now. Call me crazy.
So what I really like about this is, yeah, you're right. It's the price. So we're paying basically $1,000 for each call contract. So we're paying what was it? Showed at 10 for
$10.
5 strike call. We have a year and a half. For us to break even on this trade, Morgan Stanley has to do 15% in the next year and a half. That gets us to 115, and that's break even territory by the end of expiration. Is that right, Sean? So
correct.
God forbid Morgan Stanley has a move anything like it experienced the last bull market, where let's just measure this out because some might not believe it. A big bank like Morgan Stanley up 300% from the COVID lows to the 2021 highs. So if Morgan Stanley does anything that resembles 300%, right? We need 15% to break even. This is going to be a great trade.
Just I'm curious. I see what you did there.
It's just data, facts, Sean.
Can you do that same exercise to measure the move from that breakout in late 2020 to that high? Like, forget the COVID bottom. I don't know. I feel like, yeah, right there. What's that gain?
90% after the breakout occurred.
90%. See, that feels more attainable to me.
Yeah. So if we print 90% at this, that means Morgan Stanley's trading around 190, and those calls are $85 in the money.
Yep. That we paid $10 for.
All right. I'm into it.
That's a great trade.
I'm into
it.
All
right. I like it. Look, I actually like it as a straight call play. All right.
Yeah, me too.
In fact, I think that's how I'll publish it. I'll publish it as a straight call play, and I'll give people the option, like, hey, you might, if you want to get cute with it, knowing that you might risk capping your upside in a way that you don't want to do, you could sell calls against it, kind of treat it like a covered call play. Yeah, I think that's the move.
Because Morgan, this is a catch-up trade in a way, right? And what you're saying is this one's probably ready to leave, right? And look more like Goldman, which would be the closest comp you have, right? So this is what Goldman looks like, already to and through those prior cycle highs. If Morgan does that sooner rather than later, you probably don't want to be selling any calls. So we'll see.
Yeah,
I like it.
All right. Hey, this was a good exercise. I like this. Well done. Way to bring your A game, Straza.
Big banks, they're calling us right now, man.
Yeah. All right, folks. So there you have it. We like Morgan Stanley. We like buying the December 2025 expiration. So that's not this coming December. That's next December, 18 months from now. We like buying the 105 strike calls for under $10. And if you want to get cute, you can calendar spread it, play the rolling short call game if you want. Maybe that's an expert level move. Don't make any moves without consulting your physician or me. I'll talk to you through that. But yeah, I like this trade. This is how we do it, guys. This is how Straz and I and the team, we do it all the time. We just kind of throw ideas up at the wall, see what sticks. Some ideas turn out great. Some are duds. That's how trading works, right? But when we get them right, in this case, Morgan Stanley, if we get this one right, if it has a move like we've seen in the past, it pays for a lot of small losers. And that's the name of the game in trading. So thanks for tuning in, Straza. Enjoy your July 4th weekend, buddy. I hope you have the fireworks of the normal kind, not the Mother Nature inspired fireworks out that way.
I hope so too. We'll have to wait and see. You enjoy as well.
All right, buddy. Take care, everybody. We'll see you next week.